Hi, Larry Gaines, PowerCycleTrading.com. A really great trading combination is to incorporate and use seasonality trend shifts with credit spreads or selling option premium. So I've been talking a lot about credit spreads, over the years with my members and followers, and also seasonality. So I want to show you this trade setup and how nice it fits together, combining both seasonal trend shifts with credit spreads for the trade setup. So here's a seasonal trend on the Russell 2000. So it tends to peak out around July the 13th, year after year after year. So this is a continuation chart to show that pattern going back 5 years, 15 and 15 years here. So you can see how it tends to go sideways, turn sideways to move lower. Well, this gives you a great opportunity to set up a real high probability trade first off by selling an out of the money, in this situation, bear call credit spread, to take advantage of if this just turns sideways to moves lower. So by doing this, it gives you a setup going into the trade that's a high probability trade to begin with by selling out of the money credit spreads, which when you do like a 20 delta short close to 1 standard deviation, that's about 80% theoretical probability that price will close below your short strike. So in this situation, sell a bear call credit spread up here, about a 20 delta short, and then when we get into August, we'll be looking for this reversal to the upside, and we could sell a bull put credit spread down below. So let's take a look. So set this trade up on the 15th of July based on that seasonality study on that reversal of a seasonal trend. So the RUT, RUT, Russell 2000 index was trading at 1565. So went out and sold about 1 standard deviation out of the money, the 1600 short, and bought the 1605 above that as protection. So you can see it was trading right about here on the market, 1565, and sold that 1600. And bought above that the 1605. So on the 22nd, which was the Tuesday, it was trading right down here at 1547. And usually when you do these types of trades, you're looking for 70% of your credit or so you can take off the trade. Now the other great thing with this one, we knew there was a big seasonality shift either sideways to down on the RUT, but we also had positive or negative, momentum on our momentum indicators here, cycle 1 and 2, which gives us a forecasted price direction in this situation to the downside. So the trade setup was, again, selling a bear call credit spread, so the 1600 short buying the 1605, and then this is based on like a 20 delta, which gives you theoretical 80% probability of that to be a winning trade, meaning that price would close, 80% probability that price will close below 1600 at expiration. All right, so about 1 standard deviation. Now this trade, these, when you do these types of credit spreads, it's what we call a negative risk ratio, because you're actually risking more than you make. So here was setting up $100 credit on a $5 wide spread, so your risk is 400, but you've got a theoretical 80% chance of this being a winning trade, plus a higher probability because that seasonal reversal trend is a very substantial trend as well. So if we look at what this actually did, closed it out at 70 cents, which was 70% of the credit received, and that's a nice return of 17.5% over just a few days. So high probability trade. So you can see here was a 1600 short, 1605 long, trading here, closed out the trade. So went in at $100 credit, out at 30-cent credit, so that's your profit the difference. So these are high probability trades, and then you go from there. So the next one we'll be looking for is that bull put credit spread when we get towards the end of August. All right, I hope this helps, and I'll talk to you on my next video update.